Good morning. I'm David Talbot, Managing Director and Head of Research here at Red Cloud Securities. Our next presenter is Oliver Turner, EVP Corporate Development of Karora Resources. While we expect ongoing production growth and cost reduction efforts to be the main driver for Karora as it looks to double production by 2020, this is likely to be spearheaded by organic growth from the drill bit. So, Oliver, you have 15 minutes to present, and then at the end we'll have a 5-minute Q&A session. Viewers, please hit the buttons and put in your questions to the text box, and we'll get to as many as we can. So, take it away, Oliver.
Great, thank you very much, David, and hello, everyone. So as David mentioned, we are expanding production to 200,000 ounces per year. I'm calling the path to 200, as you see on this slide right here. And just above that is our Higginsville mill operation, which we acquired from Westgold in mid-2019, which really set the stage for the beginning of our growth plan and the turnaround the company over the last 2.5 years at Karora. So I will tell everyone to take a look at the forward-looking statements and the disclaimers in our presentation. You can read that at your leisure. And we'll kick off with our geographic location. So for those of you who are new to the story, we are located in Western Australia, in the Kalgoorlie belt, which of course is the most prospective gold belt in all of Australia. And we're very fortunate to have a very large coverage of that prospective gold belt. In fact, our 1,900 square kilometers is the largest coverage of the belt that hosts a lot of very significant deposits in Kalgoorlie, all the way from the Super Pit and the Golden Mile down to St. Ives and Norseman just south of us. So the major belt runs right underneath our property. And we have 3 operations across that 1,900 square kilometers. The Beta Hunt underground mine, and 60 kilometers down the road, we have the Higginsville Central Mill, surrounded by a series of open pit and underground operations, past producing and current, as well as the Spargos high-grade open pit, all 3 of which are feeding our centralized mill. Our management team is led by Paul Hewitt and Graham Sloan. Paul Hewitt is no stranger to the North American audience, the former CEO of Klondex Mines, took it from an early stage single asset company with no mill, all the way to a multi-mine producer with a centralized mill in Nevada, and eventually sold it to Hecla Mining in 2018 for just over $700 million. He is replicating and has replicated that same model at Karora, where originally the company had a single asset with no mill, and we purchased the Higginsville mine and mill, and now have multiple mines feeding that centralized mill. On the right-hand side, you see Graham Sloan, who's our Managing Director of Australian Operations. Graham brings with him a tremendous amount of experience and a great following in Australia. He is the gentleman who built the Fosterville mine, which is certainly a fantastic operation, and brought with him when he joined the team in 2019 a whole range of technical personnel, and has had a tremendous impact on our cost reduction initiatives over the last 2.5 years, as well as our operational performance. Rounding out the management team is myself on the left there, EVP of Corporate Development. Prior to being at Karora, I spent 7 years at GMP Securities as an equity research analyst and a mining engineer before that. And then we have Barry Dahl, the former CFO of Klondex and Argonaut, as well as Michael Doolin, who heads up our technical services, who's the former chief operating officer of Klondex and has held multiple executive roles. So a very experienced management team, and certainly drawing on the strength of what was completed at Klondex. Before we step into the assets, just do want to mention our commitment to developing a plan to get to net zero. Over the course of this year, we were working with a net zero company to develop a plan to reduce emissions across our organization. And we have actually taken a preemptive step, or preliminary step, I should say, to invest in some very interesting offset generating projects, specifically in Australia. And this has, had multiple benefits to us, not only helping the local community, increasing biodiversity, but also has helped us in the investor space as well, and has led to some very strong buying of our stock once we declared that we had a plan there. So very excited to be sector leaders in that space. So as I mentioned, in mid-2019, we did acquire the Higginsville mine and mill. Since then, we've got a track record of producing about 25,000 ounces a quarter. We really stabilized these operations that were essentially unprofitable before, with 2 very significant royalties that had encumbered them. Not only do we stabilize the operations, but we of course reduced all-in sustaining costs as well. As you see, the trend has been our friend. We actually went from north of $1,300 an ounce US prior to the current management team joining, to that $1,000 an ounce mark that we targeted back when we first joined in 2019. So going very, very well. Over the last several quarters, excuse me, we've been increasing production as we step into our growth plan, which I'll highlight for you in a few slides here. But it's definitely starting to scale up, and those costs are continuing to be attacked despite some of the inflationary cost pressures that we have seen with COVID. In 2020, we did produce just under 113,000 ounces, which was at the upper end of our production range. And we will be releasing our financial results on March 14th, so just in less than a couple of weeks here. And we certainly expect to be within that guided range. So altogether, a very strong year. Looking forward, we will be doubling our gold production to approximately 200,000 ounces a year by 2024. Of course, all-in sustaining costs will continue to come down with it. And this is a self-funded growth plan that is coming from two primary areas: an underground expansion at Beta Hunt and an expansion of our Higginsville milling facility. But this is with the cash that we have on the balance sheet, along with our operational cash flow, very well self-funded. So we're very secure on the financial side. Attaching some numbers to the growth plan, we have our 2022 guidance here, 110 to 135,000 ounces. We did readjust our guidance slightly just about a month ago, and that was a reflection of the ongoing inflationary cost pressures we're seeing across the industry, but specifically in Australia as well. We talked to almost all of our vendors and saw a rough increase of sort of 7 to 15% across the board. So we increased our cost by about 12%, both on the all-in sustaining cost side of things and some of our other capital items there. But we are very, very comfortable with that range. And good news, as of today, in Australia, the Western Australian border quarantine requirement has been lifted, which we do expect to have an impact over the next several months on labor coming back into Australia. A lot of Western Australia relies on fly in, fly out labor, which has been held sort of captive outside of the country with that quarantine in place. So we should expect to see some relief of the tight labor market there over the course of this year. Stepping into 2023 and 2024, you can see our production growth there as well. One thing I will highlight with these all-in sustaining costs, that there is a lot of nickel upside that is not captured in those all-in sustaining costs, and I'll touch on those in a few slides. But we did, for the first time as Karora, release nickel guidance this year of 450 to 550 nickel tons. One thing I will flag is that was done at a $16,000 per ton nickel price. And of course, nickel prices are north of $25,000 per ton today. So significant upside beyond what we put on this in this table here. We do continue to invest about $20 million into the ground every single year in exploration, and that has led to some tremendous exploration success. We expect it to continue to do so in the future. Moving on to the growth plan here, as I mentioned, there's two primary components. The first is an underground decline at Beta Hunt. The second decline is already underway. I'll show you in a few slides here where we're attacking it. The budget for that is approximately $45 million Australian. We're very, very comfortable with that number. Our phase 2 mill expansion is the second component. We are in the final value engineering phase right here. And the budget for that item is approximately $50 million Australian. Again, very, very comfortable with that number. We have about 90 million Canadian on the balance sheet as of the end of 2021. And that combined with our operational cash flow, gives us a very strong coverage to finance this growth plan over the next 2.5 years. So Beta Hunt really is the crown jewel of the company. It's going to be 80% of our feed as we expand that mill to 2.5 million tons per annum. 2 million tons per annum is going to come from Beta Hunt. So not only on a tonnage basis, but also on an ounce basis, it'll be about 80% of our production profile. So it certainly is where we focus the majority of our efforts, and it certainly has yielded great results for us. We have a gold resource at Beta Hunt. We also have a remnant nickel resource, and I'll come back to this a little bit later. But the grade of that remnant nickel resource, hopefully everybody can remember this, is about 2.8 to 2.9%. We are seeing higher nickel grades at Beta Hunt, particularly in a zone called the 50C or Gamma zone, which could provide some incremental nickel byproduct credits. We will be updating our gold resource by the end of the first quarter. You'll get an updated gold resource. And we also announced just a couple of days ago that by the end of the second quarter, we'll be updating our nickel resources as well with some very interesting exploration areas that we've been targeting. So lots going on the resource and drilling front at Beta Hunt. Quick refresh for those of you who've heard the story before, and for those of you who haven't. One of the main advantages we have at Beta Hunt is that we have over 400 kilometers of existing development already in place. How is that already in place? Well, the Beta Hunt or the Beta and the Hunt mines were around for about 40 years as nickel operations, long before there were gold operations. So we really get to leverage that existing infrastructure, both for exploration and for mining, which is one of our key advantages at Beta Hunt. At Beta Hunt, we are mining in a very competent basalt unit. The ground conditions are absolutely outstanding, meaning particularly we do not have any backfill requirements. So there's no backfill requirements at Beta Hunt, which leads to far lower cost mining than traditional long hole stoping in North America. So a lot of these areas have been open for decades and holding up very, very well. One area I am going to target for the new resource update that's coming along is the Larkin zone, which is shown in green there. We'll take a look at it in another couple slides, but that is going to be included for the first time ever in our updated resource. Moving on to the second decline, we have begun the second decline from underground with our own crew. We recently announced that the contractor has begun earthworks at the portal to attack it from the top. They will meet in the middle, on track, on schedule, and that is what is going to take us up to that 2 million tons per annum from the current run rate of 1 million tons per annum up the existing ramp. We evaluated several options, shaft, a conveyor, and a second ramp, and we decided to go with a ramp because it's leveraging our existing strong operational performance and experience. So really, we're not adding anything new to this operation. We're just duplicating what we already do well. With respect to new zones, lots of new zones at Beta Hunt. The entire existing resource is hosted in the Western Flanks and A zone right here, but we have been drilling aggressively over the last year and a half to extend A zone and Western Flanks up to the north. We've also added the Larkin zone, which I mentioned previously, from discovery in late 2020 all the way through to today, a kilometer strike length. That'll be in the resource update coming out here by the end of the month. So very excited to have that included. The Fletcher is certainly starting to gain some steam here. Lots of interesting drill holes in there. And then one of our most exciting areas is this 50C nickel trough, or what we are calling the Gamma block at the southern end of the mine, which has both high grade gold and some very high grade nickel. This was the Larkin zone discovery. I won't spend much time on this slide here, cognizant of time, but just a perfect example of how we leveraged existing underground development to discover a brand new zone by channel sampling the wall and then drilling through to intersect the gold and a new nickel trough. And now, as I mentioned, that is over a kilometer in strike length. A little bit of time here on the nickel, especially the nickel update that we just put out a couple days ago. From the original discovery in April of last year, the 50C has now expanded to 200 meters in strike length by 120 meters width. So it is starting to gain some scale. Very interestingly, from the Gamma Island fault all the way to our property boundary, there are no known major faults or structures that should truncate or that could truncate the zone, which means that there is potential for this to extend 2.6 kilometers of strike length. Not only that, and these troughs and other areas of the mine are very continuous, but not only that, but we also have support from a historical drill hole of 9.5 meters of 11% that's partially along that way. So we will continue to drill this out again from existing development over the course of this year, but expect the 50C, the 30C, and the 10C to be rolled up into a nickel update by the end of the second quarter. And when you start to look at some of the grades, the 4.6 meters of 11% nickel and some of the other high grades that we announced yesterday, certainly very interesting and bodes very well for byproduct credits. Remember, our byproduct credits that we've had so far were at 2.8, 2.9%, and they were at much lower nickel prices. So you can start to do some of the math there and get pretty excited about it. One of the areas that I will mention is we do not have any nickel processing facilities ourselves. However, BHP buys the ore right from surface and processes it at their facility and their concentrator very close by. So working out very well for us. Stay tuned on the nickel. Lots of new gold in the Gamma block as well. Won't spend much time on this slide here. We just have a couple minutes left, but our discovery hole there of 40 grams over 4 meters of 40 grams was absolutely outstanding, showing that the Gamma block is not just high grade nickel, but also high grade gold there. Certainly a very profitable zone that will be into mining in the first half of 2023 is when we're targeting mining there. Higginsville, a series of open pits surrounding the mill. We are mining several of them right now, predominantly Hidden Secret, Mouse Hollow, and we're also underground at Aquarius and Two Boys. That's feeding the centralized mill. We also have some very interesting exploration targets at Higginsville. The sleuth trend, which we've talked about several times before, basically combines a known regional structure with a past producing operation, a very high grade target of where 66 meters of 11 grams was drilled, added on some air core as well as some RC that were both supportive of something potentially being there. We'll be targeting this area this year as well as part of our $20 million program, but stay tuned there. And certainly given the scale and the size of what our neighbors have in the region, with Pantoro just to the south, St. Ives just to the north, this is a very prospective area for us to look for those large deposits that we know are in the region. Last but not least, before I turn it over here to David for some questions, we have the Spargos open pit mine. That's a drone shot from December of last year. We are benching there. You know, a quick reminder that this resource here in the lower right-hand side, call it 150,000 ounces at 3.2 grams, is just the open pit resource. That's about the first 150 meters from surface. We do have a very large underground potential here. This will be an underground operation once the open pit is exhausted. And we certainly have some eye-watering drill results to chase up here, you know, an ounce per ton over 19 meters and an ounce per ton over 15 meters. Packaging all of that up, you know, for those of you that haven't been investors in Karora just yet, you know, where do we go from here? You know, when you look at the 200,000 ounce a year producers, you know, they're all around $1.3 billion market cap. We're still here today at around 820 million. So plenty of room left to grow here. What you're buying with Karora is a low risk, self-financed tier 1 jurisdiction growth story that is generating cash flow and funding its own exploration at the same time as it's funding its own expansion. So very happy to present that to everyone here, and very, you know, happy with the coverage that we get from Red Cloud. And with that, I'll hand it over to you, David, maybe for a couple questions.
Great. Thank you very much, Oliver. Great presentation there, nice and concise. So can you discuss how you expect to double the production to about 200,000 ounces by 2024? You know, at what point, what becomes the bottleneck? Would it be milling capacity, resources, mining capacity?
Yeah, no, it's a good question. So it does come from two separate areas, and I'll scroll back up here to that one diagram of Beta Hunt. Always helps to look at something. So we will be expanding the production capacity to 2 million tons per annum from 1 million tons per annum with the addition of the second decline. Our mill will be going from 1.6 million tons per annum to 2.5 million tons per annum. And, you know, unsurprisingly, given the size of the properties that we have, even once we're at 2.5 million tons per annum, we will still be mill constrained. So of that 2.5, 2 is coming from Beta Hunt. That leaves 500,000 tons per annum for Spargos and all of those deposits that we have at Higginsville. So once we've reached that phase in 2024, you know, we are going to look beyond that. How do we get beyond, you know, to a larger milling capacity? At that point in time, you probably wouldn't do another expansion of the mill. You would look at the addition of a second mill or the refurbishment of a dormant mill in the region. Nothing we're focused on today, but that will still be a bottleneck once we get there. We certainly have no shortage of feed for these mills. It's mostly a grade prioritization game where we're trying to get the highest grades through that 2.5 million ton per annum capacity, but that's what gets us to that 200,000 ounces a year.
Okay. Now you're expanding that production without shutting down the mill, you know, and you do expect inflation costs this year, but, you know, why so conservative on the production guidance? You know, you produced 113,000 ounces last year, guiding for 110 to 135 this year.
Yeah, so the main reason why, and that was trimmed a little bit from 120 to 140. The primary reason for that was labor restrictions in Western Australia. So one of the challenges that every miner is experiencing in Western Australia is retention of labor. It's a highly competitive market right now. You know, up until today, as I mentioned, it has been sealed off. So it really has been a place where you know, it's an employees market for sure. So as we're going into this growth plan, obviously we have the need for additional personnel, which we've been very successful at hiring so far. But we did want to hedge our bets there a little bit. And then the second component was the supply chain constraints across Australia. It really is an Australia-wide problem as well as an international problem right now. So we wanted to make sure that we weren't basically promising something that we had designed by mid last year. This year, that we recalibrate. We are very optimistic that we'll be at the upper end of that guided range, but we just wanted to widen it a little bit and to be honest with investors that we're facing the same pressures that everybody else in Western Australia is.
Right. Right. Okay. With that, Oliver, we are up on time. So I want to thank you for joining us today. Thank you, everybody, for tuning in. Up next, we have Serato Gold on stream 1 and Oh My Gold after a short break on stream 2. So thank you very much, Oliver.